Well, the U.S. Federal Reserve delivered the quarter-point rate cut markets had been expecting in its final policy meeting of this year. This third straight reduction has lowered U.S. borrowing costs to between 3.5 and 3.75%. That is a three-year low.
Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated.
It is the fourth meeting in a row without a unanimous vote, and the first time since 2019 that three officials broke ranks on a policy move. The dissents also came from opposite ends of the policy spectrum. Two officials voted to pause and reassess, citing the risk of reigniting inflation, while Trump ally Stephen Miron pushed again for deeper rate cuts to boost growth and deliver the administration's economic promises. For more, Mitch McCann is covering the story for CNA from New York. Mitch, analysts are calling this a hawkish cut. I mean, how did the Fed justify that latest move while signaling that it may tread more carefully in the coming months?
Yeah, very interesting announcement this afternoon. Good evening from New York. The Fed really justified this with a suggestion that the balance of risks is still leaning more on job growth rather than inflation. And you heard Jay Powell talk about that there briefly. Keeping in mind here, and I think this is important for our viewers, is that the Fed has two mandates here. One is to keep inflation steady. That's called price stability. And the other is to maximize job growth. Now, inflation is higher than they would like. It's around 3%, but it's not rising at an alarming rate. The other part, though, job growth, ensuring maximum employment, is really where the concern lies here. There's been various pieces of data this year showing that job growth in America is slowing. In fact, it's harder for people that are unemployed to get jobs now again, get back in the labour market. But the September data showed a surprise rise in job growth of 119,000 jobs. Now, that created some confusion because on one hand, job growth is slowing, but we've seen this big rise for the September data that came out delayed, of course, because of the shutdown. But Jay Powell suggested that the Bureau of Labour Statistics may be overstating job growth, and those numbers might actually be revised down to show job losses. So cutting rates means it's going to be cheaper for businesses to borrow, than business owners may be able to hire more staff. So that's the intention here, to stimulate job growth. The risk, of course, is cutting rates may lead to inflation rising. So you can see the tension there between the two mandates. I think it's also important in this statement, the Fed did not commit further, to your point, to cuts in the coming months. And a set of predictions from the Fed, they signal they may only lower rates once next year. So lots of information to take from this. But of course, those mandates really at a tension point.
Yeah, and tensions among officials as well, because dissents are rare in the Fed and multiple dissents are even more uncommon. And so how did the current political backdrop factor into this decision?
Yeah, well, look, the Federal Reserve is not supposed to be political, but that in some ways is what it's become. One of those who did not want to follow the decided rate cut today is who you mentioned earlier, Stephen Miron, one of Donald Trump's nominees to serve on the committee. He wanted a bigger rate cut. And guess who else wants a bigger rate cut? Donald Trump does. At the same time, Donald Trump's been very highly critical toward Jerome Powell, the chair, calling him, well, essentially every name under the sun, and he's resisted the urge to fire him. At the same time, Donald Trump has declared that he thinks he knows who he's going to pick as the next chair of the Federal Reserve, and it's likely to be an ally of his. The rumour is Kevin Hassett from his National Economic Council. I think just finally, one critical piece from Jerome Powell's announcement today was around tariffs, and this relates back to some of those political elements we talked about. He spoke clearly and said the impact of tariffs, he believes, what they're doing to the economy. He said with inflation currently around 3%, Jerome Powell said if you get away from tariffs, inflation is in the low twos. He said it's really tariffs. So really blaming the tariffs for inflation being around 3%. And we know Donald Trump is probably going to be even unhappier with Jerome Powell after those comments this afternoon.
All right, Mitch. Thanks for that. Mitch McCann there reporting live for CNA from New York. Well, Wall Street ended higher after the Fed's move. Now, the Fed has forecast only one rate cut next year, but traders bet that they would go further. The two-year note moved lower after the Fed announced it will start buying short-term bonds, expanding its balance sheet. The 10-year yield, which influences rates on a variety of consumer loans, also fell. And for a closer look now, we're joined by Jose Torres, senior economist at Interactive Brokers. Jose, so Dow, S&P surging there after the Fed's third consecutive rate cut, which was a widely expected move. So why is this still, such a strong reaction there? I mean, did it have to do with, the Fed not being as hawkish as feared?
Great to see you, Liz. Absolutely. On the dots, they're only expecting one rate cut next year in 2026. But then when you heard the balance sheet developments and the Fed tilting towards quantitative easing, kind of, by focusing on the short end of the curve and buying those treasury bills, offering liquidity to the treasury market, that's what stock market investors love. It bolsters the more speculative areas of the market. Also, the more cyclically oriented, rate sensitive areas like the Russell 2000 is a gauge of smaller companies that tend to have more fragile balance sheets and they're more vulnerable to the economic cycle. Liz, second day in a row, all-time high for the Russell 2000. You saw what happened with yields, as you can all see on the screen. Yields cratered downwards because once you have the Fed buying treasury bills, the next step, Liz, is okay, well, maybe if there's some issues, they're going to start buying notes and bonds. Significant decrease from the peak of the balance sheet in April of 2022 when it was 2.5 trillion, a little under that, $2.5 trillion higher. So now you're having the Fed turning around, beginning to inject liquidity into the market. As far as their summary of economic projections, Liz, you saw economic growth upgraded, inflation downgraded, and employment neutral. So that was also great for stock market participants. Folks are looking forward to a 2026 that will feature some easing via rate cuts as well as via the balance sheet, and then also fiscal stimulus. We have the signature tax bill from 2025. That's going to become more of a tailwind in 2026. And I'm expecting some of the more cyclically oriented areas of the market outside of technology to really start to lead earnings growth and expecting participation to begin to broaden out. So it won't be just the Magnificent Seven. It'll be more of a wholesome kind of market.
Yeah, so, plenty of indicators there keeping Wall Street optimistic. Yet official Fed projections show only one rate cut for next year, but markets, they're pricing in much more. Help us make sense of that.
A little more. So a little more than two, around 2.2 rate cuts, according to our prediction market here at Interactive Brokers. Liz, when you open the door to quantitative easing, you're kind of telling the market that we're looking to accommodate. And then when you look at Chair Powell's term, what's left of it, you have January, March, and April. Presumably, either National Economic Council Director Kevin Hassett will become the next Fed chair in May. That's around 70% odds. Or former Fed Governor Kevin Warsh, his odds have risen sharply in the last 24 hours or so, because President Trump set a meeting with him first. That could be because Director Hassett mentioned that he wouldn't bow to political pressure from the White House if cutting rates wasn't appropriate. However, he did offset that statement by saying that he is in favor of deeper interest rate cuts. And the reason is because AI productivity gains are going to lead to deflationary pressures, while immigration restriction is going to keep a lid on housing costs. So together, that's been the argument to want to cut deeply. I thought that the 25 basis point move was the appropriate one. However, Liz, the Fed here is essentially cutting in a heated economy. We have an overheating economy. We have a reopening of the government, and that's a cyclical tailwind. And things are looking pretty rosy into 2026 when you consider the fact that unemployment rate is low. There's changes in the labor market that's making it confusing to really analyze when you consider the immigration situation that's capping payroll gains, and then the AI adoption that's really hurting a lot of the younger folks in the labor market. Similar issue to a much less degree as what China has been having in recent years. But overall, unemployment rate still below 4.5%. That's not a bad story. Consumer spending, a little unbalanced, but hanging in there strong. And overall, pretty good backdrop around 2 rate cuts next year and quantitative easing.
That's right. I also want to get your take on oil prices. I mean, the fifth quarter point rate cut could boost economic growth, oil demand as well. And this coming as we're seeing prices rise following the U.S. seizure of a tanker of Venezuela. I mean, how significant is this for global oil supply markets and sentiment as well? I mean, this adding, another level of complexity, especially after earlier we saw reports of Ukraine's sea drone attacks on Russian-linked tankers. I mean, what could be the tipping point here for a sharper point move? And with the Fed's cuts ahead, what could this all mean?
Well, I think the oil story is not going to be that much of an issue, Liz, because when you consider energy supplies globally, we're looking at oversupply by maybe 4 to 5 million barrels in 2026. I think the reason why President Trump and the administration is really focusing on Latin America, they're turning away essentially their focus on trying to get President Vladimir Putin to negotiate on the Russia situation. They're sort of giving up on the Russia situation because they're not having any success. So they're going down to Venezuela to see if in the US's backyard they can try to influence things there. Of course, Russia is a heavy ally of Venezuela. And then, here in Miami, folks are talking about, is Havana going to be next? Is President Trump going to try to capitalize Latin America in the sense that moving more towards a moderate kind of governments and not sort of socialist, totalitarian, communist kinds of administrations?
Right. Jose, we appreciate your time, your insights today. Jose Torres, senior economist at Interactive Brokers. Do apologize for the drop in audio there.